Okay, just try and picture this for a second. The absolute chaos of an old trading floor.
Oh, yeah. The shouting, the signals, paper everywhere, madhouse.
Exactly. Now, jump forward. Today, it's, well, silent rooms, blinking servers.
Data streams moving at light speed, decisions in microseconds by algorithms,
It's such a massive shift, and that's what we're diving into today, algorithmic trading.
and how it's completely rebuilt the mechanics of global finance, really. Humans are still involved, of course, but machines are driving things now.
So for this deep dive, we're drawing on insights from a source called The Rise of Algorithmic Trading, How Technology Transformed the Markets. It gives a great overview.
And our goal here is to give you the shortcut, the key takeaways from that material. We'll look at, how it all started
Right. What are the main parts? What works well? What are the downsides?
and what it all means for traders and really anyone interested in the markets today.
We'll touch on electronic trading kicking things off, then high-frequency trading, or HFT.
The double-edged sword, as the source puts it.
Yeah, and those scary moments like flash crashes and, how people actually navigate all this.
So where do we start? The beginning, I guess.
Makes sense.
Well, the source is pretty clear. This wasn't like flipping a switch.
Yep.
It really traces back to the 80s, with electronic trading systems first appearing.
Ah, okay. So before the algos could trade automatically.
You needed the digital rails first, right? A way to trade without being in the physical pit.
That electronic pathway, moving from yelling across a room to typing on a terminal, that was step one.
Precisely. Once that existed, then speed and automation could really take off.
And that's when algorithmic trading properly emerges. The source mentions different types, but HFT gets a lot of attention.
High-frequency trading, yeah, it really does. And the source, like I said, calls it a double-edged sword, particularly for market liquidity.
Oh, okay, double-edged sword. Let's really get into that based on the source. What's the good side?
Okay, so the good edge. HFT algos, they're placing and canceling orders incredibly fast, thousands a second sometimes.
Oh, yeah.
And all that activity, the source says, drastically cuts down the spread. The gap between the best buy and sell price out there.
So it makes it cheaper for other, maybe slower traders to get their deals done.
Exactly.
Yeah.
So in that sense, it adds liquidity.
Yeah.
Makes the market smoother, easier to trade in.
Got it. So that's one edge. What's the sharper edge, the tricky side?
Well, the source points directly at the speed and how complex and interconnected everything is. That introduces big vulnerabilities.
How so?
Because these algorithms react instantly, automatically. So if something unexpected happens or there's a weird feedback loop, it can ripple through the whole system incredibly fast, potentially causing huge, sudden price swings, dislocations.
Right, that sounds like the setup for a flash crash.
That's exactly it. The source uses the 2010 flash crash as, like, the prime example. It notes how, just in minutes, major indexes just plummeted.
And then bounced back almost as fast, right?
Yeah. It was a stark demonstration, the source argues, of just how fragile these automated systems can be. Decisions happening way faster than any human could track, let alone fix.
Algos basically reacting to other algos, creating chaos.
Pretty much. But it's not all about HFT and crashes. The source does talk about other kinds of algos too, right? Not just speed demons.
Yes, definitely. HFT grabs headlines, sure, but the source mentions other important ones, like smart order routers.
Right, finding the best price across different exchanges automatically. Or execution algorithms.
What do they do?
They're designed to break up big orders, feed them into the market slowly so they don't cause a huge price impact.
Ah, makes sense. Minimizing ripples.
And things like statistical arbitrage, looking for tiny fleeting price differences between related things. Assets.
So algos aren't just raw speed. They're also about being smart, efficient, cutting costs, running complex plans automatically.
Correct. Those are the strengths the source highlights. Better prices, narrower spreads, more efficient markets overall, lower costs for investors.
But the weaknesses aren't just flash crashes.
No, the source mentions other things too, like just how complex these systems are, the risk of bugs, or unintended consequences.
And overseeing code that runs itself in markets that change constantly. That sounds tough.
It is. And ensuring the data feeding the algos is actually good, accurate data. That's another big challenge mentioned.
Okay, so with all this speed, automation, complexity, where do the humans fit in now? Clearly not yelling in pits anymore.
Yeah, the human role has totally shifted. The source talks about this. It's less about manual execution, more high level.
Like what?
Like designing the systems, being the quant analysts, managing the risk of the automated strategies, or being experts in market structure, finding opportunities the algos might miss.
So using brains, not just voice boxes, more data analysis, programming skills needed now.
Exactly. The toolkit is different. Data, code, not just a phone and a trading jacket.
It's a whole new skill set. Okay, so looking back, we've gone from the noisy pits to this quiet, powerful digital world.
Yeah, electronic trading first, then HFT coming in. Powerful, but complicated.
We've seen the benefits, like efficiency, but also the risks, like those flash crashes, big changes.
In understanding this, it's not just theory, right? It's fundamental to how today's markets actually work. It affects everything.
Absolutely. And thinking about those lessons, like from 2010, and how much more we rely on automation now,
Yeah.
it leaves you with a pretty big question, doesn't it? As markets get even more automated, how do we find that sweet spot, between pushing for maximum efficiency and managing the very real risks that come with systems moving faster than we can think?
That is the million-dollar question, isn't it? Balancing efficiency and risk in this digital age. Definitely something to keep thinking about as things evolve.